Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss how the bond market performed during the pandemic. And Phil, since that day, February 28th, 2020, that kind of was the day where we started to see things go downhill as the pandemic accelerated and we moved into March, how dramatic was the sell-off in equities when the U.S. went into quarantine?
Yeah, I mean, it all started actually on February 28 when we had a record volume day, but obviously we went into quarantine a couple of weeks later, and that's when the sell-off really started. It was the sharpest sell-off, but it wasn't the deepest sell-off we've ever had in the equity markets. But it obviously had a huge amount of volume. It caused 4 market-wide circuit breakers and a whole lot of volatility, and a lot of companies were closed down. So there was a lot of uncertainty about future earnings and future valuations.
One of the things we also spoke about was liquidity. That was a concern. Was liquidity also an issue for fixed income?
Yeah, and it wasn't really clear at the time what was going on in a lot of different asset classes, especially because fixed income doesn't have a tape like equities do. There's no bids and offers, there's no record of trades. And so what we found out as we went further forward in time was actually there'd been huge amounts of cash raised by companies, of redemptions across equity mutual funds and bond mutual funds. Hedge funds were liquidating positions. Basically, everybody wanted to go to cash.
How did that impact bond ETF trading since underlying bond liquidity evaporated?
Yeah, really good question. So when you actually got the data, you realized that the bond market liquidity, the depth of the bond market liquidity went down about 5-fold. So there was a lot of asset classes, a lot of longer dated, like less currently issued bonds where there was apparently no bid. So just no market maker willing to put a bid out. A lot of the market makers just didn't have inventory to keep buying back from investors that wanted to sell in the bond market. And really the equity market was the opposite. So bond ETFs, the volumes went up 5 times. And the market is obviously, equity markets are bid and offered constantly. So there was a pretty competitive quote all the way through the day, continuous markets, 5 times the normal liquidity, and the ETFs performed pretty well.
So was there any dislocation in the bond markets at any point?
Yeah, I mean, the interesting thing is people pointed to the fact that the net asset value of the ETFs and the actual price of the ETFs were different on a couple of days specifically. And really, when you look at some of the data coming out of the bond market later, what's pretty clear is the ETFs were trading and the bond markets were quite stale. So the index themselves was basically still holding bonds from days ago and saying, yeah, the market hasn't fallen yet because the bonds from days ago haven't traded. So the market's higher than we all think. And then it would trade and it would come down. So the disconnect we saw in ETFs was probably more stale bond indexes than it was to do with the equities and the bond ETF markets. We saw heaps of other dislocations now that we've seen some data within the bond market. So a lot of very short-term debt. You saw dislocations in terms of, rates were going down for one very short-term debt, but up for other short-term debts. You saw the spreads on treasuries that weren't current. So the not on the run treasuries blow out much more significantly than front month treasuries. And you can kind of see there that normal relationships that would keep those rates intact just completely dislocated.
How impactful was the Fed's rapid and massive response?
I mean, I think you can see in the results, it was really impactful. The bond market settled down pretty quickly. The ETFs went back to trading at their NAV. And you can see, obviously, the liquidity that came into the system, it reduced a lot of the stresses. The equity market bounced pretty quickly. And I think all of the studies that have been done in sort of looking back at the Fed's responses show that it definitely helped liquidity. It helped the markets to get back into line. So those spreads came back to normal. Credit spreads came back to normal. Bids came back into markets that were less liquid.
What performed better at the end of the day, bonds or bond ETFs?
I mean, I guess I'm biased, but I would say bond ETFs. I mean, they had a continuous market. They were trading buyers and sellers, 5 times normal liquidity. And nothing really broke. It was a success story. I think one of the things that people were really surprised at was the liquidity stress actually came from mutual fund redemptions, not from ETF redemptions. There was much more flow coming from the mutual fund sector. ETFs themselves just were a vehicle for liquidity at the end of the day.
What's the next test for bond ETFs with the Fed eventually unwinding?
Yeah, so the Fed's actually started unwinding a holding of bond ETFs a couple of weeks ago, and no one's really noticed. So I don't think the test is as big as people thought. I think, part of, I guess, the Fed getting back to normal and reducing its balance sheet is to start to reduce some of their bond holdings. The bond ETF purchases they started to unwind, but it turns out the amount of bond ETFs they bought is just a fraction of the total inflows into those bonds that we saw over the last 12 months, because there's still been a lot of people putting money into bond funds.
And finally, Phil, what were the lessons learned for the markets?
I like to think that the transparent equity markets really held up. Having competitive bids and offers, having all investors closer to one place trading was good for markets and good for investors to know where to go to get liquidity, even in this time of crisis.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.